So I have to say, I think Tom Lee is going to be correct in his predictions for a large small cap rally. Tom Lee also says a cyclical rally, which can include some value stocks and dividends as well. I think Fed Jerome Powell today just confirmed that. And I will go over some of the main highlights from Jerome Powell's speech today, what Wall Street is saying, and what could come next for markets. Nick Timiraos, widely seen as the Fed's mouthpiece, writes on X, "The Powell pivot is complete. Powell is dovish across the board, from the same stage where he 2 years ago signaled the Fed would accept a recession as the price of restoring inflation." Here are some of the most notable quotes. Quote, "The cooling in labor market conditions is unmistakable. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress towards price stability." Powell unfurls his narrative on the causes of and behaviors of inflation since 2020. Recognizing not everyone will agree with his framing, he concludes with this, quote, "That is my assessment of events. Your mileage may vary." After recounting the series of judgments that led officials to describe inflation as likely to be transitory, Powell observes how widely shared these views were outside the Fed. Quote, "The good ship transitory was a crowded one." So Powell, in his speech, he went back to 2021, more specifically, the measures the Fed and the government did to stimulate and boost the economy so we did not have a depression. And then went on to talk about the spike in goods inflation in the beginning of 2021, how they thought that was transitory. But really, by late 2021, early 2022, they knew, yeah, this was not transitory, and started to raise rates. This was kind of like, I don't know a great example of this, but if you do something, let's say you are faced with, being homeless, losing everything, or going all in on a business, right? Going all in on something like Elon Musk did with his earnings from PayPal, went all in on Tesla and SpaceX. It was kind of like that, where Powell was just looking back at where they were in a sense of victory, in a sense of, we came from there, we are now here, and those issues are over with. That was a lot of this speech that we got today, in my opinion, was a victory lap on inflation. Now, of course, Fed Jerome Powell's never going to come out and say, inflation's over with, it's dead, we don't have to worry about it anymore. Like, CPI doesn't even matter. He's never going to come out and say that, okay? But that's basically what he said. He was talking about inflation in the past tense. Like, it's not an issue today. And Jerome Powell made it very clear that if there is weakening in the economy, the Fed is able to respond to that. Carl on X writes, "The S&P 500 is on pace to enter Jackson Hole with the second strongest year-to-date performance since the year 2000, weeks after Jackson Hole. It's quite unprecedented to see the Russell up 2+% today, at some points 3+% today on Jackson Hole." This was on CNBC right as Powell was speaking. This is the Jackson Hole's performance. So average performance is negative 1.4% during the speech. That's rough. There's only been 2 times where the markets have actually been positive during this speech, and that was 1995 and 2007. So it doesn't happen all the time. The last time, coincidentally, that the markets were higher is the soft landing period that you've seen in 1995. The average return 1 day later is negative 1.3%. And the average return until the next Fed meeting is negative 0.8%. So I know there's going to be a lot of people that go out and say, historically markets fall after Jackson Hole. Yes, that's true. But you did have it's kind of 50-50, right? In 1995, you had a soft landing. Jackson Hole was positive. 2007, you didn't have a soft landing, but Jackson Hole was still positive for markets. I think during 2007, it was kind of like today. A lot of people thought there was going to be a soft landing because the Fed had raised rates over the past couple of years prior to the same level in which we're at today. So a lot of people were excited about 2007 that the Fed was going to start cutting rates and maybe there was going to be a soft landing. So I think what I really take out of this is if you are actually going to get a soft landing, Jackson Hole tends to be more positive. Okay. And that's where we are now. It's like, the victory lap on inflation. Although, 2007 was not a soft landing, we have to see what the incoming data does. One thing that I found very interesting was Fed Jerome Powell did not explicitly confirm September as the first cut. He basically did without saying September. He kind of said September. So I think September's all in the bag. We don't even have to think about September anymore. They're going to cut rates in September. But he really didn't clarify what the path forward would look like. If we're going to get a cut at every meeting, if it's going to be a purely data-dependent approach, meaning that we get a cut in September, but let's say September CPI comes in a little bit high, October CPI comes in a little bit higher, then doesn't necessarily mean we need to see a cut in November. I think there's some uncertainty around how many cuts the Fed is really going to do. And the markets are still pricing in about 100 basis points of easing throughout the next 3 Fed meetings. So it's going to be a fine line between the economy being too weak and the Fed cutting rates enough. Bank of America says 5 of 6 Powell Jackson Hole speeches saw the S&P 500 drop 7.5% on average in the next 3 months. Who's left to buy? S&P 500 corporate cash, just 8.8% of assets, often a bearish tip-off. So you already have Bank of America saying we may actually see a sell-off after this Jackson Hole speech. Obviously, probably not today, but over the next couple of weeks, that's a possibility, although I'm leaning more towards Tom Lee on this one. I do think Jackson Hole tends to have a negative precedence around it, but again, at Jackson Hole meetings like we seen today, where it was basically the end of an era, the end of the inflation era as we know it, as the Fed fighting it as we know it is now over with. I don't think there's as much historical precedence on that. These Jackson Hole, end of era speeches are pretty rare, right? Again, 1995 was the last time we had something along those lines, the last soft landing we had, and markets did very well. Markets did well for years after the soft landing in the mid-90s. So from that perspective, this time could be very different than other Jackson Hole speeches we have had in the past. But keep in mind, September tends to be a terrible month for stocks over the past 10 years. You could see this. The S&P 500 was down 4 years in a row for the month of September. The last time there was a 5-year September losing streak was 99 through 2003. Seth Golden says, have Lim. We'll travel out upon SPX to deliver positive return in September 2024. Not advice. Not financial advice. So he thinks September is going to be positive. But when you look at the 10-year average for September, you are negative 2.6%. Every other month is positive besides December being negative 0.2%. November is the standout best month in the past 10 years at positive 4%. October is also positive 1.7% over the past 10 years. But really in recent years, September's been rough. 2023, you were negative 5.1%. 2022, you were negative 9.6%. 2021, you were negative 5%. And 2020, you were negative 4.1%. So, yeah, there's a lot of, recent seasonal trends that would tell you September is going to be rough. But again, how often do you have the Fed basically declaring victory on inflation and presumably what could be a soft landing coming over the next couple of months? How often does that truly happen? Not often. So I think this time is very different. We are seeing the Russell that is up about 2.8% today, the S&P that is only up 0.4% today. And although this is a large outperformance of the Russell, and I don't expect that we will have, multiple days or weeks of this continued huge outperformance, I do think you are starting a new trend of small caps, of value, of dividend payers, of cyclicals that will outperform the S&P for likely many months to come. And that's essentially the call that Tom Lee made yesterday, that you are going to see small caps do very well. He actually thinks small caps could rally 40% by the end of this year. That's aggressive. I think if you have good economic data and the Fed cutting rates with inflation coming in lower than expected, that is certainly a possibility. But I think at the bare minimum, you are going to see the Russell outperform the S&P. And today, the Russell is outperforming the S&P by over 6x. Dustin Terry on X writes, if Warren Buffett is the Oracle of Omaha, Tom Lee is the Nostradamus of New York. Funstrat on X writes, real rates are 3 times higher than at 2023 Jackson Hole. One of 3 reasons why we expect markets to ultimately view Fed Chair Powell's comments dovishly, equaling a risk-on post-speech. David Rosenberg says Powell let the cat out of the bag when he said that the jobs market is looser now than it was in 2019. What we know about 2019 was that the Fed was cutting and went all the way down to 1.75%. So let's just say that it's nice to know the destination point, which the Treasury market, as strong as it has been, has yet to fully reflect. So he's suggesting the Fed's going to cut a lot further than what other officials have said on the Fed, which is around 3%. Powell could actually go down to 1.75%. And that's exactly what Fed Harker said today. He said the neutral rate is somewhere around 3%. Goldman says we continue to expect that the August employment report will be stronger than the July report and that the FOMC will deliver a 25 basis point cut in September, but think that a 50 basis point cut would be likely if the employment report is instead soft again. And that's really the next big catalyst for markets, as markets kind of broadly speaking, is the employment report, because the Fed still kept an aspect of data dependency, and the markets are going to react, a lot more to bad data, right? At this point, good data is probably good for markets. Good economic data is good for markets. Bad economic data is bad for markets, and it could be really bad for markets depending on the scale and scope of just how bad the data is. And if you are bullish on markets today, you want to see as good of economic data as we possibly can get. Good economic data will help to send the Russell higher, because the Fed cutting interest rates doesn't matter. It's about, why is the Fed cutting rates? Is the Fed cutting rates because inflation's falling and the economy's holding up? Great. Is the Fed cutting rates because the economy is weakening and we're going into a recession? That's really bad. The other big catalyst coming up soon is NVIDIA earnings, which will actually take place next Wednesday. We do have a couple of other earnings here. Wednesday and Thursday are your bigger days. Wednesday pre-market, Abercrombie & Fitch, Chewy, Kohl's, Foot Locker, Bath & Body Works, RBC, and JM Smucker. Wednesday and after hours, NVIDIA, CrowdStrike, Salesforce, Affirm, Okta, Pure Storage, Viva, Five Below, HP, and NetApp. Thursday pre-market, Best Buy, Dollar General, American Eagle Outfitters, Ollie's, Campbell's, Burlington, Birkenstock, 1800, Flowers, and others. Thursday and after hours, you have Dell, Lululemon, Altria, Marvell, Gap, Autodesk, MongoDB, and Elastic. Take a listen to this clip on CNBC that says the economy will remain strong, says Bianco Research president, a well-respected firm on Wall Street. And if you are bullish on markets, you need to understand the economy, right? You need the economy to remain strong. If the economy does not remain strong, it doesn't matter how many cuts the Fed gives us. Stocks will fall and not do well.
Back now to Jackson Hole and what we just heard from the Fed chair, with major averages rallying higher this morning. Bianco Research President Jim Bianco joins us. I think of you as bond guy, Jim. So we did see bonds rally, treasuries rally on the back of this speech. The dollar also lost some of its gains and weakened pretty substantially. Were you surprised at all at what we heard and the market reaction?
No, I wasn't surprised because the speech was more of a confirmation of what the market had been expecting. And the rallies that we're seeing just undid yesterday. There was a fear in the markets, both in the bond and the stock market, that Powell might come out a little bit more hawkish than everybody thought, and he didn't. So we undid yesterday, and now we're going to try and parse through the speech. I think the big takeaway in the speech is obviously they're going to cut rates in September. We know that. But we don't really know how far they're going to go after that. How much do they plan on going, hundreds of basis points or 3 or 4 rate cuts and be done with it? He did imply that the labor market is now going to take center stage. The payroll report is going to probably surpass the inflation report as being the most important statistic of the month.
So what is the bond rally telling you? The fact that they're increasing odds of a 50 basis point cut in September, the fact that there's still 100 basis point of cuts priced in by the end of the year, does that look right to you or a little much overdoing it?
Well, I'm in the no landing camp, and meaning that I don't think that the economy is having a soft landing. I think it's doing better than that. And I fear that all of these cuts that we've got priced into the market might be overdoing it and set the stage for sticky inflation throughout 2025. So I'm on the opposite side of Chairman Powell. I don't have confidence that we're on the way to 2%. Now, we've seen this before. We saw this in January, incidentally, coming off of another Powell speech where he kind of said we're on the way to 2%. And then inflation shot back up in January. And then that put on all the cuts for all year on hold until September. So I think that the economy is going to continue to stay stronger. Now, the bond market, it kind of reacts to what the Fed is doing and a little bit of hope in that they're going to get rate cuts because the market wants rate cuts and it wants to see that the rate cuts are going to go there.
What are you seeing in the inflation reads that the Fed is not seeing that keeps you worried about it?
It bottomed a year and a half ago at 3% on CPI, and it really hasn't really made any progress. It's a 2.9 now. It's taken almost a year and a half to go down a tenth. The seasonality, or what we call the base effect,
has gone down to 2.5%. That's moved more. And that's what they care about.
Right, but core inflation has gone down, but also the same thing with that, right? The Fed's target on core PCE is 2%. It's not 2.5%. And and there's evidence that that might be bottoming it near these levels. I think we're at those cyclical lows in inflation. And again, because I think the economy is going to do well, one last thing is inflation is probably the hardest economic indicator to predict, but everybody on Wall Street thinks it's the easiest economic indicator to predict. And go back to transitory 3 years ago, and even Jay Powell got a nervous laugh in the crowd when he acknowledged that they got that completely wrong 3 years ago. It's a difficult thing to predict. They're basing everything on this idea that the labor market is weakening, but the data in the labor market is very mixed. Whether you're talking about the SOM rule or the recent revisions down, there's an argument to be made that we've had a big expansion in the population of the country via migration, and that has been bringing different demographics into the labor market, which makes looking at the unemployment rate going up not clean. And that's why Claudia Sahm herself has said that maybe her recession indicator is not going to be correct because of the increase of excess supply. I wish he would have addressed that. He seems to be taking the data at face value. If the unemployment rate goes up, we have to cut. Is it because we've got migration pushing up the unemployment rate? He isn't addressing it.
That was very interesting. Let me know what you think about that down below in the comment section. Today on CNN's Fear and Greed Index, the index is sitting at 50, which is exactly in the middle of neutral. It's exactly between 0 and 100. So there's a lot of room for markets to get more strength here, or potentially, weaken from here if things did go down that road. But I do think Tom Lee is going to be correct, and we are going to get a strengthening market, a broader rally in the internals of the markets. But the one area that I would avoid like the plague right now is big tech, okay? Big tech, for what it is worth, the Russell is up 3% today. Meta is down 0.67%. Amazon is down 0.1%. Microsoft's down 0.6%. Google's up 0.5%. Apple's up 0.3%. This is not the area you want to be in if we do have a soft landing, if the Fed starts to cut rates and overall inflation continues to fall. Like, that's just not where you want to be. You want to be in small caps. You want to be in value, in high-paying quality dividend stocks, cyclicals. That would be the area to invest in. It's not big tech. Big tech has had their moment. It's worked well because there's been this recession fear, this recession risk for the last 2 years. These companies are self-financed, so they're not going out and raising debt at these very high levels. They have a ton of cash, which is helping to boost their bottom line profitability via all of the interest that they are collecting. And for really those three main reasons, big tech has done very well. All of that starts to unwind if we have a soft landing and the Fed starts to materially cut rates. Here today, you can actually see this represented well in the percent of stocks trading above their 50-day moving average. Even as the S&P has been falling and the Russell has really been holding up today, you're seeing the percent of stocks above their 50-day moving average going up to 66.83%. Here today, 9.6% of all stocks are breaking above their 50-day moving average. So what you're really seeing is a broad-based market rally, but big tech is not participating, and big tech is really, not participating and driving down the S&P 500, which is a much different story if you look at the Russell 2000. And really, from the perspective of this chart, there is a lot more strength that we could still see in the internals of the markets. Back during December and November of 2023, the last big kind of broad-based rally that we've seen that actually lasted a couple of weeks, a couple of months, if you will, you got as high as 86% of stocks trading above their 50-day moving average. I think you could see something similar to that again, especially as this unwind happens from investors selling big tech and buying other areas of our markets. Those billions of dollars of selling are going to do a lot more for upside in the Russell, in value, in cyclical stocks that tend to be smaller cap in nature. So I don't know if Tom Lee is correct about a 40% rally in the Russell 2000 by the end of this year, but I think he's correct in the sense of that's the place you want to be. Small caps, value, high paying dividend, like any stock paying you 4+% dividends that presumably at that point, the dividend yield should be pretty safe if it's only paying you 4%. Normally, you get compensated off of risk. So you really want to start looking at a dividend stock and saying, hey, is there risk embedded in this dividend? If it's higher than like 6%, 6, 7, 8, 9, 10%, it's like, oh, that dividend might be cut. That might not be safe. But, mid-paying dividend stocks, 4, 5, up to 6%, could be very attractive on a risk to reward basis as the Fed starts to cut rates. Same is true again with small caps, with cyclical stocks, and with just growth more broadly. That's where you want to be. And I think that's why you're seeing the massive outperformance in the Russell today. And I do think you're in for a large rally over the next couple of months. I don't think the historical precedent of Jackson Hole being this big bearish catalyst needs to necessarily be repeated again. I think there's something powerful in the Fed taking a victory lap on inflation that we don't see all the time at Jackson Hole. So it's very easy to say, oh yeah, Jackson Hole typically causes a sell-off. But how often do you actually see the Fed chair take a victory lap on inflation at Jackson Hole? Doesn't happen too often. Last time was in the mid-90s and markets did very well following that Jackson Hole speech. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.